the market crashes once again, and Warren Buffett makes a ton of money. That's been in the headlines for the past 5 crashes at least, right? And literally, everyone reads the same economics textbooks and journals. So how does he do it? We've traced back his latest trades, and found the 5 solid reasons or rules, which Mr. Buffett follows to make consistent profits, especially in market corrections. So, to sum up the past couple of months, they were a real mess. The S&P 500 has dropped 13.73%, the Nasdaq is taking a beating, and billionaires have lost $200 billion across the top 10 year to date. Yet, Mr. Buffett's made a profit of $12.7 billion. You already know Buffett's reputation as the greatest investor ever, but how is he thriving in this environment? First, we'll have to take a step back and look at the big picture. Now, let's examine what value investing is, and how to use it. With the S&P 500 down 13.73%, volatility is creating mispricing opportunities, and he's capitalizing. He avoids growth stocks with inflated multiples. Instead, he's targeting durable companies with strong cash flows, trading below their true worth. For example, Coca-Cola is up 20% year to date, trading at $69, with a 4% free cash flow yield. Chevron has gained 4% at $156, with a 5% dividend yield. Meanwhile, Apple's down 27%, but Buffett's not worried because he's positioned defensively. So picture this. It's late March, the market's in a freefall, and growth investors are getting hit with margin calls. Buffett's in Omaha, running discounted cash flow models on companies like Coca-Cola. He sees its 3% dividend yield, global moat, and a PE of 24x below its 5-year average. The market's 14% drawdown doesn't faze him, and he's buying value at a bargain. That's the precision that's driving his $12.7 billion gain. Now just to clarify real quick, moat stands for a distinct advantage a company has over its competitors that allows it to protect its market share and profitability. And the PE ratio basically shows you how much investors are willing to pay for each dollar a company earns. Buffett focuses on intrinsic value, not market sentiment, and he simply buys when opportunities come up. That's what value investing is. But even if you learned all about measuring intrinsic value and started investing with that strategy, what happens when you face a 20% crash? You just hold right? Wrong. If it was that easy, we'd all be billionaires. So let's explore Buffett's psychological edge, which in these markets is a real game changer. The VIX has averaged about 30 points over the past 2 months, which is a level not seen since the 2020 COVID crash. The VIX is a volatility index, and it shows the market's expectation of 30-day volatility. So the implied volatility on S&P 500 options is pricing in 2% daily swings. And retail sentiment, per the AII survey, is at its most bearish since 2022, with 45% expecting further declines. Buffett, however, remains unfazed. This connects to behavioral finance because Buffett avoids biases that derail most investors. One such bias is loss aversion. Having a $1 loss feels twice as painful as a $1 gain, and this bias is what often drives panic selling during crashes. Another one is the herd mentality bias, which is amplified by constant news cycles. They essentially push investors to follow the crowd. Buffett ignores all that. He's not monitoring daily NAV, or reacting to a -2% S&P move. He's running DCF models, targeting 8 to 10% FCF yields, and buying when the market's oversold. Be fearful when others are greedy, and greedy when others are fearful, is what allows him to capture real value at trough valuations. That's precisely how he's $12.7 billion in profit. History proves it. In 2008, with the VIX at 80, he invested $5 billion in Goldman Sachs, at a 10% preferred yield. In 2020, with the VIX at 50, he repurchased $5 billion of Berkshire at a 1.2x price-to-book ratio. Now, with the VIX at 30, he's likely positioning to buy quality assets at a discount. But even if you can deal with all that psychological pressure, what you actually own is what matters. In simple language, the reason why most investors lose during crises is because they are overexposed to the wrong sectors. Buffett focuses on building a portfolio rooted in stability, cash flow, and resilience. Now let's analyze his portfolio construction, because this is where the truth lies. By the final stretch of 2024, Berkshire's equity portfolio was valued at $350 billion. Apple, at 28% of the book, is down 27% year-to-date, trading at $188, with a forward PE of 28x, which by the way is still high. American Express, 12% of the portfolio, is down 15%, with a PE of 18x. But Coca-Cola, 9% of the book, is up 20%, trading at $69, with a PE of 24x and a 4% FCF yield. The FCF yield is basically the ratio that compares the free cash flow per share a company is expected to earn against its market value per share. Chevron, 8% of the book, is up 4%, at $156 with a PE of 12x and a 5% dividend yield. Buffett's positioning in defensive sectors like consumer staples is genius in a high-rate inflationary environment, with the 10-year Treasury yield at 4.5% and CPI at 3.2%. These sectors perform well. Consumer staples are up 10% year-to-date, energy's up 5%, while tech's down 20%. Oh, and here's where it gets interesting. Buffett's wholly owned businesses like BNSF Railway and Geico generate $150 billion in annual operating cash flows, with Geico posting $10 billion in underwriting profits in 2024. This steady income stream seriously helps him navigate market volatility. But it's all about management. You can't expect to make a single right call and stick with it forever. Without rebalancing, investors risk holding onto overvalued assets or missing the chance to build cash when it matters most. The classic example are the people buying into hyped tech stocks at their peak, only to watch them crash 30% with no liquidity to buy anything else. Buffett avoids that by trimming certain positions at the right time to free up cash for new opportunities. Here's how that strategy looks like in action. Buffett trimmed Apple by 10% and Bank of America by 5% since the second stretch of 2024. By doing this, he freed up $30 billion for his cash reserves. But why trim Apple? Here's a little something he learned in the School of Hard Knocks. Buffett learned from the dot-com bubble in the year 2000 that when tech stocks like Cisco traded at 100x PE, then they ended up crashing 80%. So he stayed out and later noted the following conclusion in his 2001 shareholder letter. He wrote, "We have no ability to forecast the economics of tech companies. It makes you question how the economics of these tech companies really work, right?" In 2024, Apple's price-to-earnings ratio hit 35x, which is above its 10-year average of 25x. And that's happening while facing slowing iPhone sales growth and tariff risks under Trump's policies. Buffett saw echoes of the dot-com era, with overvalued tech in a high-rate environment, often leading to a correction. So he rotated into Coca-Cola and Chevron with price-to-earnings ratios of 24x and 12x. These are sectors that historically outperform during inflationary periods, like in the 1970s stagflation, when staples returned 8% annually while tech lagged. This sector rotation, informed by past market lessons, is the reason why Berkshire's stock has risen 9%, but even the smartest investing strategy can fall apart without the right structure behind it. So let's dive into Buffett's structural advantage, which is quite simply just smart cash management. By late summer to early fall of 2024, Berkshire's cash reserves stood at $325 billion, which is one of the largest corporate cash positions ever recorded. In today's high-rate environment, with the Fed funds rate, that cash is earning roughly $17 billion annually in risk-free income on short-term treasuries. That's $17 billion of passive cash flow before he even makes an investment. But the real advantage is optionality. With the S&P 500 down 13.73%, valuations are attractive. The S&P's forward PE has fallen from 21x at the start of 2024 to 18x now, and that's telling us there's undervaluation in certain sectors. Buffett's $325 billion allows him to deploy capital at these levels, targeting companies with 10 to 12x forward Ps, which is well below historical norms. So while others face liquidity issues, with margin debt at $650 billion in the first 3 months of 2025, Buffett can buy quality assets at a discount. This is capital allocation at its peak, and Buffett's using his cash to go long when the market's oversold. That $325 billion is 20% of Berkshire's trillion-dollar market cap. And that offers unmatched flexibility. With the VIX above 30, which is basically signaling max fear, Buffett can exploit mispricings which others can't. That's a key factor in his $12.7 billion net worth increase. Looking forward, with the S&P 500's forward PE at 18x and the 10-year yield at 4.5%, Buffett has $325 billion to deploy. We believe he will target sectors with strong moats and high FCF yields. Something like energy, at 12x forward PE with 7% FCF yields, and consumer staples, at 20x with 5% yields. If volatility persists, he might double down on names like Chevron or Procter. Perhaps even a little gamble on businesses with 3 to 4% dividend yields, and 5 to 6% free cash flow growth. For us, the lesson is clear. Target 10 to 12x price-to-earnings ratios, keep 10 to 20% of your portfolio in cash, and buy when the VIX spikes to capture true value like Mr. Buffett. So to sum up, Warren Buffett's $12.7 billion gain in a market down 14% is a testament to his mastery of value investing, capital allocation, and emotional discipline. He's the greatest because he plays a different game, which is a focus on value, maintaining discipline, and executing with precision. That's why we study his every move. Where do you think Buffett will deploy his cash next? Share your thoughts in the comments. And if this breakdown added some of that real value, hit that like and subscribe for more deep dives into the market's top players. I'll see you in the next one.